This episode is sponsored by Tegas. Understanding expert insights is table stakes for investors today, and there's no better option than Tegas. I've been using them for years to get up to speed on companies, and they've helped me immensely as an investor. Tegas also recently acquired both BAM SEC and Canalys, adding a super fast way to access SEC filings and earning calls via BAM SEC, and offering access to more than 4,000 fully drivable financial models with Canalys. Tegas is well on their way to building a full suite of research products that can displace the legacy terminal providers like CapIQ and FactSet. And I'd encourage you to check them out if you hadn't recently. They are moving incredibly quickly with many new features and data sets. As a bonus note, blog readers will know that I run a bi-monthly deep dive series sponsored by Tegas. In them, I go deep into industries and companies with fascinating questions using Tegas expert calls. I'd encourage you to check that out if you're interested in seeing how expert interviews can help you learn more about a company and industry. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, follow, review, subscribe wherever you're watching or listening to it. With me, I'm happy to have Chris Lee. Chris is a student at Duke University, MBA student at Duke. Chris, how's it going?
Good, Andrew. Thanks for having me.
Hey, thanks for coming on. Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone that nothing on this podcast is investing advice. That's always true, but that's going to be particularly true today because we're going to be talking about a very small nano cap stock, 100 to 150 million market cap. So that obviously comes with lots of extra risk, liquidity risk. Smaller companies have lots of, it's tougher to get financing, all that type of stuff. So people should just remember, please do your own research. Nothing on here is financial advice. And then second, with the pitch for you, my guest, you're coming on because you won the Dorsey Stock Pitch Competition, that attracted dozens of pitches from college students all across the country. I thought your pitch was great. Congrats on the win. And, I wanted to highlight some really good work from somebody who's kind of up and coming in the finance world. So when you won it, I talked to Edwin and said, hey, whoever wins, we'll have them on the podcast. So that's it. We're going to dive into your pitch in a second. There'll be a link to that in the show notes if anybody wants to see it. But, since this is a little bit of a different episode, why don't you just give a little bit about your background so listeners can get to know you a little bit?
Yeah, thanks, Andrew. As an MBA student, I didn't realize the competition was primarily undergrad. So like I told you earlier, I kind of just wanted to win the Tegas access. But a little bit about me, MBA student at Duke School of Business, first year. Prior to business school, I was working in the consumer goods industry for a couple of different food companies in corporate finance, and also did a stint in sales. Outside of kind of that experience, I've always been interested in the stock market. My dad and he kind of taught me young about the market, but turns out he was kind of more like a day trader, momentum type guy. So I'm very different than him in terms of my philosophy, but yeah, passionate about finance, passionate about investing. I consider myself kind of an individual investor on the side right now. And I'm primarily focused on small and micro cap companies. So Delta, the company we'll talk about, the pitch I wrote, we'll talk about, it kind of fits that. But just as an individual investor, have access to management at companies of this size and don't feel like I'm at a disadvantage. In fact, probably actually might even have some info or analytical edges in this space, just as an individual. That's pretty much kind of a quick spiel about me. Looking forward to talk about the company.
Yeah, no, just two things on that. First, Tegas is I know they sponsored Edwin's competition and they're sponsored this podcast. So happy to hear that. But when you said I kind of entered the competition just to win the Tegas access, I was like, my God, that was the first thing you told me. I was like, my God, this man's an MBA student. And that is literally the greatest recruiting catchphrase that I've ever heard. Like, hey, all I want is Tegas access. If you're looking for fundamental investors, I don't know what is better. And I'm going to make sure to email my contacts over at Tegas and let them use that as a catchphrase going forward if they want to. But all that out the way, let's dive into the company we're going to talk about today. Again, microcap, so everybody should keep that in mind, consider those risks. But the company is Delta Apparel. The ticker there is DLA. I actually, this has been pretty popular in microcap circles. I've known about this company for a while, but that's neither here nor there. I'm going to turn it over to you. What is Delta Apparel and why are they so interesting?
Yeah, sure. So Delta Apparel is about $100 million market cap, vertically integrated apparel manufacturer. So apparel manufacturing, pretty boring business, but there are some interesting segments that I guess get me excited. So essentially, the company has three main business lines. The first one is Delta Activewear, which is about three-fourths of the revenues currently. But that's kind of your bread and butter, basic apparel, business, right? Kind of boring. They sell to, a diverse set of customers, just providing basic activewear. Uh, Most of the manufacturing footprint is in Central America as well as the US, and it's a very diversified customer base where no customer kind of makes up more than 10%. That's not what gets me excited, but it is a very core part of the business, just generating the vast majority of the revenues, about three-fourths. The two more sexier sides of the company would be first is DTG to Go, which is a digital printing business. And so essentially what Delta, the capability they have is they can partner with brands and manufacturers to provide a digital print service. So what this basically means is that instead of having to hold physical inventory of a lot of different SKUs, Delta can print it for you on demand, and they'll integrate with your supply chain. They'll be in your factories. They'll integrate with your e-commerce sites. They'll also ship it to anywhere in the United States in less than 2 days. So this is a business that I believe is misunderstood. Honestly, a lot of it is the way the company is, the disclosures they give. It's embedded within Activewear, Delta Activewear and DTG are kind of combined in the same segment, so that muddies the water a little bit. Secondly, they don't necessarily provide regular disclosures about DTG. It's been spotty, so it's kind of hard for investors to understand kind of what the growth trajectory looks like, what multiple they should be placing on this business. But medium to long term, the company has said, hey, this is a 20% plus revenue grower at a 20-25% EBITDA margin, which that's like much better, different profile than kind of the boring, right, commoditized activewear business. So that's exciting. The third piece of the business is called Salt Life. So Salt Life is about a little over 10% of the sales. This is I guess, regional lifestyle brand currently. And so you've probably seen bumper stickers saying, with the Salt Life branding, if you're driving anywhere in the South, even in the Midwest or West Coast. And so with Salt Life, they're rapidly expanding their retail footprint. The unit economics are pretty strong at retail. They also have a sizable DTC e-commerce business. And again, just like DTG to Go, it's very margin accretive to the business, and also a business that is, it should command a higher multiple than your kind of commoditized Delta Activewear segment. So I think what caught my attention is, COVID was call it catalyst for these guys, where people are buying more, physical goods, right? So obviously that's a good thing, but the valuation where it sits right now, trading about 4 times forward earnings, trading below tangible book value, which is like $17 a share. I think we're at like under 15 today. So I think, unfortunately, I've been long a little bit, earlier. So I'm a little bit of a bad holder right now. I do think it's a very attractive entry point, just because if you think about the long term, where this company is going from a commoditized apparel business to one where they should generate, like 45%, 40 to 50% of their revenues from more attractive, higher ROIC businesses, higher businesses that have more of a moat around it, either branding or technical capabilities in digital print. And so, in the pitch, I kind of said, hey, this business to me, deserves to be trading at 8 times at least, which is kind of an industry multiple. And that puts you at about $35 a share. But I think that the value is actually even higher, just given, Salt Life could be worth the entire kind of enterprise value today, and things like that. So that's kind of, me rambling about why I like the company.
No, that was a fantastic overview, and I want to dive into a couple of different things there. I think you could probably tell I'm going, but let's start with one thing. Just you mentioned the valuation, right? This is trading 4 or 5 times forward earnings, which is also doubles as about 4 or 5 times trailing earnings. It's trading underneath tangible book value. So I do think people need to keep that in mind. A lot of times I'll have people on the podcast and somebody will go into the comments and say, hey, this company isn't the best business in the world. And the response will be like, yeah, but it's trading at 7 times earnings. Like here, it's below book. It's below. So people need to keep in mind when we're talking about this, like you're really getting paid for, yeah, it's not the best business in the world, but you're really getting paid that. But just on the valuation, on the book value side, right? $17 per share tangible book. It's actually about 25 or 26 if you include the goodwill there. A lot of the tangible book here is accounts receivable, which is fine. Those are generally from very good customers, but a lot of it is inventory, right? You're talking at June, 227 million. I believe there's a big buildup as they work towards kind of the summer seasons and the fall seasons, which is the big for the athletic gear side, but 227 million of inventory. Like how comfortable do you feel that inventory is like, we just went through 2021 and Target's writing off all of their home decor inventory and everything. How confident do you feel on that tangible book value?
Yeah, Andrew, that's a great question. I didn't even mention the book value in my pitch because I didn't want to go down this inventory rabbit hole. But if you think of Delta's inventory, it's mostly blank T-shirts, right? And so like this is not like a Target like high fashion or even like medium fashion where the trends go out of style and all of a sudden you got to write down inventory, sell it, fire sale it. These are T-shirts that are literally already have a customer on them. They just need to do what they need to do, print on them, right? So to me, the inventory is almost like it's pretty, you can think about it more like more liquid than your traditional apparel inventory just because of the nature of what they sell. And even talking with the company, right, a lot of that 200 mil or I think $160 million in inventory, they already have a home for. So it's kind of already spoken for. It just hasn't been converted into cash. Right. So if you look at their cash balances, it is low, but I like to think for them, this is different than, other apparel companies, but for them, because they're selling blanks, it is more liquid and not prone to kind of write downs as other, clothing businesses.
No, that's great. And I think you mentioned a lot of the inventory is blank T-shirts, and this is going to come out a lot in the pushback, but when you say a lot of the inventory is blank T-shirts, that's good because it's pretty fungible, right? Like if this company went belly up, you'd have 5 different companies be like, blank T-shirts so you could probably get close to book. But the pushback would be, and we're going to talk about this for all the businesses except for Salt Life, which is different, but pushback would be, okay, cool. They're selling blank T-shirts in DTG Go, which is where I really want to spend more time. Yeah, they're doing stuff on demand, reducing them, but they're also just like screen printing T-shirts and selling them. Like, what's the real edge here? This is never going to be a business that is worth more than tangible book or a lot more than tangible book because it's about the most competitive, least advantaged business I can imagine. And you can kind of see this. Like I was just flipping through the proxy statement the other day. So I'm looking over here. They pay awards based on return on capital employed, ROCs, I believe what they call it. And, their target to get your bonus is 10%, which 10% is fine. It's a little bit above the cost of capital. Like if you're doing that in this industry, it's great, but it's tough to see how this, like you said, 10 times earnings, 35, 37 per share. That's 2 times tangible book, 1.5 times goodwill, like 1.5 times normal book. It's tough to see how you get there when you start saying, they can barely earn above their cost of capital. Does all that make sense?
Yeah, I think it's a very fair pushback for sure. I think on the legacy kind of activewear business, there's a couple of things I would mention. So first of all, the pandemic exacerbated this, but there is a trend from sourcing from Asia and overseas and moving that more onshore. And so Delta being, primarily located in Central America and the U.S. have an advantage in terms of nearshoring, right? Because it's the security that it provides their customers is one, I guess, advantage. The second thing that this does is Central America labor market is quite good for Delta. Through the pandemic, talking to management, it's not like they're having labor shortages. People want to work, and they're happy to work at a company at Delta. That's a good job for the workers there. So, from a manufacturing standpoint, stability and labor, those are good. Those are good. Again, not huge advantages, but those are definitely advantages. How it fits with DTG and even Salt Life, kind of the blank business, I will say that the vertical integration in this arena actually does matter. So, the digital print business, right? They're leveraging the ecosystem of the activewear business and having those, high availability of those blanks they can print on. And, I don't know the exact numbers, but they've shown over time how most of the T-shirts they're printing on are internally produced versus outside, right? So it's kind of like there's a little bit of an ecosystem effect there. Again, not a huge competitive advantage, but I will say on the digital print side, if you look at the competitors, it's really like Amazon, has a business that's, it's hard to get a read on, who, I guess
shockingly, the Amazon digital T-shirt printing business isn't exactly the number one thing they're talking about with investors.
Exactly, right? But they're kind of seen as the market leader, and DTG is, by most accounts, the number 2 player. Then you have kind of like a lot of different tail competitors, right? So let's think about deciding between going to Amazon and Delta. Well, Amazon's going to have all your data as a brand. You might not want that, right? They're not vertically integrated, which Delta is. And Delta can still deliver to the US within 2 days, which is a capability, Amazon could tout as well. So I think just looking at the landscape, they're positioned okay in that regard.
Let's actually come at it from a different track, right? Because So they've announced 2 big people who are using their digital print widget, DTG to go or whatever it is. The first one was Hot Topic, which I was laughing with you earlier. When they announced Hot Topic was their number 1 client, I was like, okay, cool. There's the real paragon of retail in there. But the second one was Fanatics, right? And anybody who's studied the sports business or anything knows Fanatics is a multi-billion-dollar company. They're eating share like crazy. They took over the Topps trading card business. Like this is the behemoth in sports apparel and sports memorabilia. So that is a real partner. And a big piece of their business is, hey, the Patriots won the Super Bowl. We want to get people Patriots Super Bowl champion t-shirts within 24 hours, right? So you could see how not only is Fanatics a real company, you could see how perfect this is for their business. So can you just walk me through, not the economics of the partnership, but like, why does Fanatics partner with them? What are they doing for Fanatics? How does that, obviously not the economics, because we don't know the economics, but how does that partnership work? Why would Fanatics choose to work with them versus in-housing it, going with 50 different partners across the country for every local market, all that type of stuff?
Yeah, I think DTG offers an end-to-end solution for a company like Fanatics, right? So I'll talk a little about the technology. On the surface, like it doesn't seem that hard. They buy a digital printer, they print it, they fulfill orders, and it's pretty much what they do, right? But they've actually worked with the company that manufactures these machines, and from what I understand in talking to the company, there is somewhat of a proprietary process where over time they've worked with that manufacturer and know how to operate that machine the most efficient manner, right? So there's some technical know-how that DTG brings. And they've also worked with large customers such as Hot Topic, where they've been able to integrate in their customer supply chains and kind of fulfill those orders, right? So Fanatics, to me, is a little bit of a game changer for the company because actually it's likely going to be the largest customer for Delta Apparel as they ramp up. So they only started recently. This Q4, they're on their Q4, which they're reporting soon this month. It will be the first quarter where they have a full quarter of Fanatics business in the books. But I think Fanatics understands that they have Delta has an end-to-end solution. They've done it with big customers before, big retailers before, and they're building specific capacity and technical processes for Fanatics. So, Cornet, which is a digital, printing machine manufacturer, widely seen as the industry leader in digital garment printing. Delta is not using their machines for Fanatics. They had to work with a different company to come up with a process that met kind of requirements that Fanatics had from a quality standpoint. So actually, I do think quality here is a selling point, and the fact that they'll be able to do it with large customers. So that's kind of the Fanatics side. But for Delta, it's great because now you're getting a sports-based customer, high growth, that's not as tied to kind of like your traditional fashion cycles, right? So like all end of the year, like holiday rush, right? Fanatics gives them a little bit more diversification in terms of when the peak times are, right? So the sporting events have different, Super Bowls, different time. It's not all holiday merch season. It could be February, the Super Bowl. It's going to be March Madness. It's kind of consistent throughout the year. So that's kind of what's in it for Delta.
So in many ways, Delta, tell me if I'm wrong here, but Delta could say, hey, oh, look, obviously we need to stock up for the back to school season is going to be massive. The return to team sports is going to be massive for an athletic apparel focused business. Christmas is going to be massive. But guess what? Fanatics has almost a completely different peak season, right? Super Bowl is obviously their peak. As you said, March Madness, you could imagine NBA playoffs, that type of stuff. So, hey, we've got all this. It's not all excess capacity. We have to build extra stuff for Fanatics. We have to go to different markets. But in some ways, they've already got the capacity. This Fanatics partnership just lets them kind of smooth it over. Am I thinking about that correctly?
Yeah, I think so. I think they're also, I did mention they're building specific capacity for Fanatics, and they're still ramping up. And so a lot of the CapEx, I believe, was meant for Fanatics, and they still have a lot of throughput improvements. So they're not even they don't even have all the Fanatics business. They only have a slice of a pie. It's hard to triangulate how much the full TAM is, but based on my research and talking to the company, there's a long runway of just Fanatics business. So, like one of the conference calls, I think the CEO mentioned, hey, we're not going to onboard any new customers, and people started getting worried about that. But like, listen, they have so much. I think what his point is, there's so much Fanatics growth alone that can carry them without kind of onboarding smaller customers.
Yep. Perfect. Okay. I think that's good on the DTG side. So let's just talk about, I think the interesting piece here is the Salt Life side, right? Because as you can probably tell, like I'm a little skeptical of the base business in DTG to go, but again, you're paying under tangible book value. So the market's clearly experiencing some skepticism. So you don't need things to go swimming there. But Salt Life is really interesting to me because it is the type of thing that I've seen companies do and incubate. And obviously there's tons and tons of risk there. This is a small brand. I don't want to run too far ahead. There's tons of risk, but this is the type of thing I've seen companies grow to be billion-dollar brands. It's 100 million market cap. So I'll pause there. I'm rambling a little bit. What is Salt Life and why am I so interested in the possibilities there?
Yeah, so Salt Life, if you live under a rock, you've never been to a beach, then you might not have seen Salt Life. But Salt Life essentially is a lifestyle brand that celebrates the outdoors, the fishing, and just being on the beach, right? So different than the rest of the Delta business, it's branded and they, own their own retail locations. And so what gets me excited is a couple things. First of all, the retail build out. So they started the year with 13 stores and they're up to like 21 now.
Yep.
So that's large growth there, but the unit economics are quite strong in terms of the build out, where they're generating I don't have exact numbers for me, but very strong cash on cash returns when they open new stores, and there's plenty of opportunities in terms of potential locations, right? So this is a brand that's most well known in the Southeast, those kind of beach towns, but there's no reason why they can't expand into, in the Northeast, West Coast, and things like that. So at 21 stores currently, you could probably, over a decade, 5 times that number and and still not reach saturation. And so currently, this company, Salt Life on its own should generate around 10 million in EBITDA for FY22. And it's not crazy to kind of assume a 7 to 8 times multiple on that, right? It's comparables are in that range. And so to me, this is kind of a early growth story in terms of the retail build out, but then also on the e-commerce side, again, margin accretive to the overall business, leveraging the blank t-shirts from, the Delta Activewear side. So there's definitely a lot of synergies being in the ecosystem, but a decent amount of the revenues will come from e-commerce, and the retail and e-commerce are, like I said, margin accretive to kind of the wholesale business. So a lot to be excited about, but it's mostly kind of like the maybe spin-off potential. They are reporting Salt Life financials separately, and they're doing that on purpose to leave the door open for something like that. But it's not crazy to say that, Salt Life alone is worth, 2/3 or almost even all of the value today.
No, I'm completely with you. Look, this has been, I think, the most interesting part of the story. As you said, it's in the first 9 months of the fiscal year, 46 million. So they're probably going to do what, 60 million? I think you said it in FY22, about 10 million in EBITDA. That's growing really quickly. It's growing 20% plus revenue per year. Margins are expanding as they kind of get over the build out stores. Like, that's the type of thing you could see. It's almost fun with numbers, right? But 2-3 more years of 20% growth, all of a sudden you have $100 million revenue brand doing 20 million plus in EBITDA. Like, that's the type of sexy small cap, mid cap growth story you could see the market getting excited by. You could see a private equity firm getting excited by. You could see a strategic taking it out and using it. So that's why it's so interesting to me. And you mentioned like everything you said with margin accretive, all that type of stuff. Like, I 100% agree. I don't disagree. And I think the backdoor to that is, hey, it's just a better business to own the brand and have like a brand that people are searching for than it is to just produce all these different things. Let me provide some pushback on Salt Life. I think the first pushback would be, look, and this will actually go a little bit into management. This management team has run Delta Life since, I think the CEO has been there since the late 90s. Delta Life IPO'd in 2000. Like, the stock hasn't done great, but it hasn't done terrible, right? It's like a 3x since they IPO'd. It's actually beat the market since the IPO, though it's pretty much flat over like the past 15 years or something. But, I think the first pushback would be, hey, they're growing this direct to consumer lifestyle brand. Is the CEO who's run a like on-demand apparel, athletic, like kind of commodity shop, is this the right management team and company to build out this lifestyle brand?
Yeah, that's a fair pushback. I think so. The company IPO, it was a spinoff, and the CEO's been there ever since then. He owns a sizable percentage of the shares. So I think the first thing I'll say that there's definitely strong alignment with management there. The CFO is relatively new. She's been there like a little over a year. So it's hard to say kind of what her how she fits in longer term. But listen, they're good at what they do in terms of, making blank t-shirts, right? They have separate, Salt Life is run as its own segment, so there's leadership there. I'm not too familiar with whoever heads up that division, but I would just say, like, for me, I look at more of the execution. So when they started FY22, they said, hey, we're going to build out, 7 new stores, and they did that, right? So from that standpoint, like, there's no reason for me to doubt their ability to execute. And I think having that experience on the blanks side is beneficial because, they can source a lot of their t-shirts internally, which is a good thing. And it seems like from a store selection standpoint, they are doing a good job picking the right markets, picking the right locations. And so it's kind of like, I'm not worried about it until something goes wrong. And, in recent history, Salt Life has been firing all cylinders. So I just go back to having that alignment with management that helps me sleep a little bit better. But in the past too, Salt Life's been trying to do all sorts of different things, make sunglasses and things like that. It's like, listen, you guys are good at selling your brand, opening stores, selling the apparel. Like, just focus on that. I think they're doing that.
Yeah, no, look, I definitely hear you there. I'm laughing at the sunglasses because they're selling $300 sunglasses, which I get you're a lifestyle brand, but you're selling,
Man,
if I
come
remember
on.
correctly, the shirts are like $25
Yeah,
shirts.
yeah.
So with $300 sunglasses, it doesn't really make a lot of sense to me on that dimension.
Doesn't
But
match up.
yeah, no, it's really interesting. I think of this almost, I don't know if they're still a popular brand, but I remember back when I was like kind of just coming out of college and stuff, everybody talked about the Life is Good company. Do you know them?
Yeah, I'm familiar with them.
Yeah.
The comparables I had in mind were like Tommy Bahama and Vineyard Vines, which are like, they're doing like $500 million in sales or more than that. So to me, I don't know what Life is Good sales numbers are, but there's no reason like Salt Life, in my opinion, can't be, something like that in the $500 million range longer term.
Yeah.
I mean,
No,
they have
I thought
$2 billion, 2 million decals have been sold. So there's cars, 2 million cars in the United States rolling around with these decals, and they definitely punch above their weight in terms of the social media following. So I definitely think this is like a regional to national story, maybe even international.
I did think Vineyard Vines when I was looking at this company as well, but Vineyard Vines is just like a little more upscale. And
Yep.
the funny thing, so they're Salt Life isn't going to be more upscale, but the funny thing is I was going to say, and Vineyard Vines is bigger. It's like, yeah, they're bigger because they grew and they like expanded into lots of little different things. That's what Salt Life could do over time. Though, at the same time, the beach lifestyle, like I'll wear it on the podcast. You can wear it casually, but I don't know if it has quite as many like growth opportunities as Vineyard Vines, which people started using some of them for like a lot more occasions. But yeah, look, I think it's a really interesting company. One of the things I love, if you go on the website, all the male models they use are like they're actual guys, right? Like I'm sure they are models, but it's a middle-aged man who he's in okay shape, but it's not like he's sporting a 17 pack or something. There's another guy who's got a little bit of a gut, but it just looks like the people who are actually using the product, which I think is like kind of interesting for authenticity and everything. Anything else we should be talking about on Salt Life?
No, I think we covered that one pretty well.
Obviously, they reported as a separate segment. I think it's really early. They're growing stores. I'd almost like to see them grow the store base a little bit faster and lean into that. But what do you think the end game for Salt Life is? Like, there's three options, right? Salt Life grows 20% per year for the next 5 years, and it becomes bigger than the Delta brand, and they resegment themselves as like Monster Energy drink used to be a different company, and then Monster grew so big they rebranded themselves Monster. Like Salt Lake grows so big they rebrand the whole thing Salt Life. Option number 2, they sell it to someone in a few years, or option number 3, they spin it out. And obviously all of these are assuming it's successful, but which one of those 3 do you think would be the most likely?
That's tough. I mean, I think a spinoff or sale makes sense to me. I guess as a shareholder, those 2 options would probably unlock the most value. On the flip side, though, I do think like there is a benefit to being in the, I guess, Delta Apparel ecosystem, just from a blank T-shirt standpoint.
Yep.
So I honestly I don't have any like unique point of view on this. I do think the spinoff and the sale would unlock value, and so I guess I am more rooting for that. But I see the other side.
You're a true investor, rooting for it. You know what? It'd be nice to take the mark. Let's sell this.
Exactly.
Thing. I like it. Just 2 more things that kind of came up when I was researching these guys. We just talked a lot about how they do a lot of disclosure around Salt Life. And when you mentioned the DTG to go or whatever, you said, hey, they don't really provide disclosures. And one of the things I was impressed with your write-up is you went through a lot of old things they said. I think you had something at the 2020 annual meeting. They gave a little bit of, you use that to kind of back into the revenues for DTG. But, I look at the company and say, okay, well, they know to disclose a lot of stuff on Salt Life so people can start valuing that. And they're really cagey on the disclosure on this high growth business that they think they're going to grow rapidly. They're taking share with Fanatics. When I see a company being cagey around disclosures with a segment like that, the first thing that pops in mind is, oh, the economics of this segment are really bad. They know it, and they're trying to kind of hide the ball from investors. It just goes back to the worry I originally had there, but I just wanted to expand on that a little bit and give you a chance to kind of comment on that.
Yeah, I think it's fair, and it's a frustration I know other investors have that they've kind of brought up the company. But I think so. I think the long and short of it is basically they were disclosing the revenues and rough margins or targeted margins when things were going well, which was kind of like 17 through 20.
Yep.
And then based on like piecing things together, either from transcripts, old disclosures, old investor decks, talking to other investors, I believe that the revenue actually dropped in FY21, and so obviously you might not want to disclose a high growth segment that's all of a sudden facing tough comps and had a down year, right? The second piece is on the profitability. I do think like the Fanatics ramp up is hurting margins, and this is not something they're being cagey about. The CEO Bob mentioned on the call, the last conference call, say, hey, listen, like we're running at like essentially flat break even operating income margin. But once all this, once we ramp up our throughput, which they can increase like 40% or higher on the Fanatics line, they're going to get in line with kind of like 15% operating profit margins and close to 20% EBIT margins. So I think it's a combo of basically like DGG did have a down year in 21, and that there are short-term profitability concerns, but in my opinion, those will be alleviated once they exit kind of the startup phase. But yeah, listen, I like talk to professional investors and they can't piece. Like I asked them, hey, what numbers you got for DTG? And they're like, oh, look at notes, I don't have it. Like so. There are people that own the stock that don't even know like the revenues by year for this segment, right? Which is kind of scary. But like you said, if this is a high growth segment that can do 20% plus 25% EBITDA margins long term and should on a normalized environment be growing 15 to 25%. Listen, that multiple is much more than what the legacy business deserves. And so I think if they want to realize that value of this segment, they have to do a better job with their disclosures. And I think the new CFO recognizes that, and they're adding a little bit more in their SEC filings, but it needs to be consistent. So hopefully next year we'll see some more information on that. But yeah, it's definitely an issue.
Perfect. And then last question I just want to talk about. I know you've talked to management a little bit, it sounds like, but I just wanted to ask about management because they seem good to me, right? Like obviously I think Seeding Salt Life, which as you can tell, that's what I'm most excited about, I think has the most potential getting through COVID in a kind of commodity business that has some leverage. Like I think all of that speaks really well to them. But there has been a little bit of hiding the ball with the margins, as we just discussed. The CEO, as I mentioned, he's been here for 20 years. The stock's flat over the past 10 years. It's a 100 million market cap company. They are a little promotional. I think, as you mentioned in your write-up, there's only one analyst covering them, but it's a sponsored analyst, which is always a little bit of a red flag for me. And I was just flipping through their website and their investor race. He went on the TD Ameritrade network to talk about Delta a couple months ago, which there's nothing wrong with that, but the host clearly had no clue who Delta was. And they were just like, you're an apparel company. Tell us about inflation and consumer, and didn't ask about Delta once, which it just screams to me a little bit of a company that's trying to be promotional. And I just wanted to discuss that. I don't want to say red flag, but it was a little bit to me.
It's funny you say that because I actually have the opposite view. I don't think they're promotional at all because so the analyst coverage, I mean, listen, no one's going to cover these guys, right? So like the sponsored research, it gives you a little bit of attention. I don't think that's necessarily something you can knock them on. I think historically, like the last couple of years, they do like one conference a year, the ICR in the West Coast in Q1, and that's pretty much it. So it's not like they're hitting the micro cap, all the conferences and doing all that kind of stuff, right? The TD Ameritrade one is interesting because that kind of was a step out of what they normally do from a outreach standpoint. If you listen to the interview, though, the guy he was not he didn't say anything that investors, would have taken as bullish, because they were talking, the conversation was focused on inflation and passing through pricing. So like, I was excited when he went on, because hey, getting the word out on this name is good, but like he didn't say anything that could be construed as bullish, in my opinion. So, and that was the first kind of retail outreach. It's a retail focused oriented platform, right?
I'm with you, because the TD Ameritrade thing, like, look, you get it. It's a professional network. It's a professional anchor. Like, obviously, it's not CNBC or something, but they invite you to come on. Most people are going to take up that invite, so it's hard. Just when I watched it, I was like, oh no, the anchor did no work on the company. So it's more the anchor than them, but it just like kind of built into that thing. So let me just one more point of pushback here, right? Like, it's 100 million market cap company. As you even said, hey, they have one analyst. It's a sponsored analyst, but that's because no other analyst is going to care about 100 million market cap company, which my answer, yes. But at the same time, like, you're 100 million market cap company, you're doing a stock roadshow every year, or a stock conference, 1 or 2 every year. You're doing 4 earnings calls. You're paying for a sponsored research. And most people estimate the cost of being a public company $1 million to $2 million per year. Like, you throw it all together, and it's like, hey, why are these guys public? Why don't they just go private, sell themselves to private equity, management take private, whatever it is, and spend that, let's say it's $2 million all in public company costs for the public company cost, the accounting, and the sponsor research they're doing, plus the management time. Take that $2 million and throw it back into Salt Life. Take that $2 million and put it out to dividends to your new private owners. Like, I don't care, but just why? Why?
Yeah, I don't have a great answer for that, but I will say there will be value that's unlocked if they are sold to a larger company, right? So I think like the competitors in the space, they see, the digital printing capabilities, that's attractive. They see a fast growing brand, that's attractive. So, I mean, I guess when you put it that, I've never thought about it this way in terms of the cost you mentioned, and which is why I don't think they're a promotional company. But when you frame it the way you did, I understand kind of where you're coming from.
Hey, and look, this isn't a Delta specific thing, though the sponsored research, it does take a different angle. But this is the question I ask every 200 or 300 million market cap company, right? Like, why? If you're spending $3 million per year and you're a $300 million market cap, just go private and put that money in your pocket or something,
Yeah, I think, one potential catalyst is the CEO is getting older. And he, like, he's a career industry guy, when he wants, there's probably a point where he wants to exit, and the private equity exit is one that I think could, or hopefully would, unlock value.
All true. And if I remember correctly, I'm trying to flip through the proxy real quickly as we talk. He owns like 6 or 7% of the company. He owns 6.1% of them, which, when the stock was at 30, that was real money there, right? Now that it's at 15, still a lot of money, but it's not quite as real money. But if you think it's worth 30 in a sale, that's real money, real value unlock. Maybe split the company up into sell the commodity business to one person, sell the Salt Life side to the other. You could imagine a lot of value unlock there. Mint a pretty penny and keep all of that public company costs in your pocket instead of paying it out to a bunch of different fee providers. Chris, I think this has been great. I always like to ask before we wrap up, anything that we didn't hit that you think we should have been talking about? Anything we kind of glanced over you think we should hit harder?
Yeah, I'll just kind of reiterate some of the key points I made, because I don't know if we touch on all of them. But the first one is that, obviously inflation's on everybody's mind, right? This is like you said, commodity, consumer discretionary.
Cotton inflation has been a big driver here. Cotton inflation has been a big driver here.
So I think one of my points in the write-up was that, listen, like cotton inflation was terrible this year. Essentially, they're short cotton in perpetuity, right? But even with that, like, listen, the FY22, they are probably going to finish with the highest operating margins in recent history for the company. And if you take a look at the chart in cotton, it's obviously come down quite a bit since its peak. The second thing we kind of touched on it with the Fanatics, essentially DTG is running at flat operating profit margins. That will go back up to 15% once the ramp up happens. So that was one of my points. Just given how much more room they have on the throughput improvements, which they can do without spending a lot of money. But long term, and we touched on this throughout the conversations, like, listen, this company is going from a very boring one where they generate 75% of the revenues from a legacy commoditized activewear business to one where in the near and long term, about half of the revenues will be DTG and Salt Life. And so with that, you have better or internal investment opportunities. You have more of a moat. So DTG, I mentioned, there is a technology moat, and being vertically integrated helps them. And then Salt Life, it's a well-known brand, so there's a moat around that, right? As that mix changes long term, I feel like it deserves a higher multiple as a result of that. So those were the three kind of key points in my write-up. I think things like trading below tangible book value, trading at 4 times earnings, Salt Life potentially being the biggest, worth the entire market cap today, potential spin-off, like those are all kind of cherries on top. This is a very cheap stock, and it's not that crappy of a business if you think about the medium and long-term potential. So
that's another slogan I can take for many portfolio companies that I own or look at. It's not that crappy of a business.
It's not that crappy. And there's alignment with management in terms of ownership. So that's cool. And the board. Yeah.
Well, Chris Lee, really appreciate you coming on the podcast. Look, again, Chris is MBA at Duke first year. So anybody who wants to read his write-up, get in touch with him. I'm going to include a link to the stock pitch that won the stock competition in the show notes. So anybody can go on there. His email is right at the top of it. So you can easily reach out to him on that. So Chris, thanks so much for coming on, and looking forward to chatting soon.
Thanks, Andrew. Hell out of fun. Thanks for going easy on me.
I don't think I did, but you did great. Thanks, man. A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.